This is Introduction to Trading, brought to you by the Falae Trading Academy, where we trade smart and invest better. My name's Falae, and in this video we'll be talking about what trading is and the various participants in the various markets we trade. We'll start off with the types of markets. We have the Forex market, which is the largest. We have the Commodities market, and we also have the Indices and Cryptocurrency markets. What is trading? Trading involves buying and selling financial instruments such as stocks, bonds, currencies, and commodities responsibly with the aim of making profit. Now, I stress the word responsibly because if you're not trading responsibly, you're a gambler. And gambling involves making unrealistic trades and having unrealistic expectations. So we'll start off with the foreign exchange market, where one currency is simultaneously bought in exchange for another. So if you believe the value of the euro will rise against the US dollar, you can buy Euro USD to US dollar to capitalize on that movement. Who are the participants in the Forex market? We have commercial and investment banks who trade the largest volume of currency on behalf of their clients, as well as their own trading desks. We have central banks who represent their nation's governments in fixing the price of their currency against others. We have retail traders who speculate on price movements of currencies using online platforms. The commodities market is where raw materials and physical goods are traded on commodity exchanges. Examples of commodities are gold and crude oil. And participants in the commodities market are producers, and producers are entities responsible for extracting, growing, or manufacturing commodities. We have consumers, and consumers utilize commodities in the production of goods and services. We have speculators, and speculators embrace risk in pursuit of profits. We have investors. Investors view commodities as an investment class in a similar way to stocks and bonds. The indices market. The indices market refers to the trading of stock market indices, which represent the performance of a group of stocks from a specific market, sector, or economy. For example, we have the FTSE 100 index, which is the index for the top 100 companies in the UK, the US 500 or S&P 500, which are the top 500 biggest companies within the US marketplace, and the EU 50, which are the top 50 companies within the European Union. Participants in the indices market include retail traders, who are individual traders or investors trading for personal accounts. We have institutional investors, which are large organizations such as mutual funds, pension funds, hedge funds, and insurance companies. We have hedgers, which are businesses and investors looking to protect against adverse price movements. We have market makers, which are financial institutions or brokerage firms that facilitate trading by providing liquidity. We also have central banks, which indirectly influence indices through monetary policy, for example, interest rates. We have governments and regulators, which set rules and guidelines for fair trading practices and maintain market stability. We also have end users, the businesses or individuals who use indices for specific purposes related to their underlying asset or liabilities. Cryptocurrencies. Cryptocurrencies are digital or virtual currencies that use cryptography for security and operate on decentralized networks based on blockchain technology. For example, we have Bitcoin, Ethereum, and altcoins. So why trade? There are three questions to consider when it comes to trading. Number one, is there an opportunity to trade? Number two, how much do you risk per trade? Number three, how do you manage the trades? So, number one, risk management skills. Engaging in trading activities teaches individuals how to analyze risk, manage them effectively, and make decisions under pressure. Number two, emotional regulation, where successful trading requires self-awareness to recognize one's emotional state and its impact on decision-making. Emotional regulation is one of the key things you need to work on to become successful when you're trading, because with the wrong emotions, you're most likely to make the wrong decisions. So trade based on your algorithm and not your emotions. Number 3, trading is retirement proof, because developing the skills to trade provides the potential to trade for as long as you choose to. And according to Zapier.com, 58% of Forex traders are over the age of 40. So how to get started? Subscribe to the channel for notifications on educational material for long-term success. Learn the basics, indicators, risk management, and the psychology of a trader. And be patient. Becoming successful requires unlearning your bad habits, because bad habits are the biggest barriers to trading success. It was definitely the case for me, and I'm sure that's the case for most people who trade.